So now we turn to the international markets, and we really need to kick off with what's happening within Saudi Arabia now that they've cut their OSPs to all areas except the United States. So the U.S., it's fairly it's the same. Realistically, they should have cut medium and heavy into the U.S. Obviously, we're exporting, anywhere between 3.8 and 4.1 million barrels a day of light. So there's we're flush with light. That is not something that we need in the United States, but we do need the medium heavy. So that cut would have made a bit more sense. But again, they cut that into Asia. And the reason why that's important is because they cut super light, extra light, and light into Asia, but they cut deeper on the medium and heavy side. And the reason why that's important is because that's actually a pass-through to the refiner. And because diesel and distillate is really the only thing generating a margin, especially, around the world, but especially in Asia, by discounting that crude more, you'll be able to incentivize some additional runs. And when you put it on a seasonal perspective, the cut on the heavy side is actually fairly sizable in comparison to historic. So again, that's actually a net positive. When you look at the Northwest Europe and the Mediterranean, they cut, but they're still not going to be competitive against against CPC, Libya, and the U.S. So even though they've cut, that it'll be a benefit because there are some buyers in Europe that are term buyers. They have to buy. So that'll be a nice little bump. But when you look at Kuwait and the comments that they've made, they're seeing people very concerned about demand, and that's slowing some of the purchases that they should be seeing at this point for January, February in terms of indications of, are you going to take just term plus some spot? And that is keeping things a bit on edge. Libya set its Cider OSP for December at a discount of $2.85 to dated Brent. That's the lowest price since May of 2020. Shahara OSP was set at dated minus $1.70 versus plus $1.30 for November. So again, Libya is also is discounting. So Libya discounting is essentially completely wiping out the Middle Eastern cut. So then it's going to be interesting to see, well, what does UAE do? What does Kuwait do? What does Iraq do? And those are going to be some important pieces. Just to reiterate, because we said it in segment 2, and in case you're bouncing around because segment 2 maybe doesn't matter to you in terms of your job, CPC they've moved their loadings to a 2-year high in December, but they're having issues in terms of getting through the Turkish Straits. 19 tankers loaded with CPC blend are now stuck, with 7 more expected to arrive over the next 10 days. And the reason why is because of the requirements that they're saying for insurance. So realistically, in total, there's about 23 million barrels that's stuck at the Caspian CPC sub for Caspian CPC because they have to show proof, insurance in order to transit, which is also creating a bit of a backlog, which is putting more crude on the water, increasing crude in transit. Now, when we put into perspective the price cut, so this is looking at Saudi Arabia lowers key crude grade for customers in Asia. And this is great when you look at the last year, but where should it be? What is normal for this time of year, which I think is a bit more important to look at. So unfortunately, this chart is a little bit harder to read because we are in 2023. The price was set for Jan of 2023. Excuse me. So you can see that beautiful little blue dot. And it's right at where prices were in 2022. And you can see that it's a bit more comparable, but it's still at the high end when you're looking at the light crude. So realistically, the light side is not what they need. West Africa is struggling to clear. Middle East still has a lot of crude to clear. But where can they be more competitive? And that is where they can be more competitive, is on the heavy crude side. So you can see that the discount is actually fairly sizable and much closer to the 20-year average. And that's, I think, going to be important to see how much can they clear, and is this going to be enough support given to the refiners so they don't issue economic run cuts, so they do maintain their current runs It's very early to tell, but this is going to be a very important piece when you look at the rejiggering of the crude puzzle as we go into January and February, given these different purchases. So when you look at the underlying data sets for China imports of crude, you can see had a nice increase, just above where it was in 2020. Crude oil imports year to date fell 1.4% year on year. So when you average it out, it's still on the lower end, but you can see that the country was taking advantage of some of these discounts. And you saw some of those adjustments as we've been showing on the super tanker side, where there was a big surge in super tankers. There were some decent discounts on ESPO, Russian crude, and which accounted for a lot of these increases because they still were not taking a lot from the Middle East. They were not taking a normal amount from West Africa. That continues to today. So a lot of these increases were really from the Russian side. Then when you look at product, you can see that there was a big spike in export products, the highest for 2022, and that's something that is going to persist based on what we've seen indications of on the gasoline and distillate front. We have seen an increase in runs coming from some of the from Shandong and some of the other refiners, which in order to maintain those runs, they're going to have to get new export quotas. And given how China, the CCP is trying to pacify those within the country, it's likely that they will award them, which will then put more product into Singapore, increase storage in Singapore, put a bit more pressure on crack spreads, which is why Saudi could be trying to get in front of that a bit on the heavier side. And then you'll see how that's going to reverberate through. As we said last week and the week before, we saw a big increase in refined products coming, and it started to show up. So now the question is going to be, how do refiners manage that and try to protect their crack spreads? Middle Eastern crude, you can see that floating storage has come down, but it's still elevated for this time of year. Typically, you get a sizable drop into the end of December. The question is going to be, is there enough meaningful movements in terms of price? But given the fact where OSPs are, you're not going to get spot buyers now. They may create spot buying next month, which is going to put a bit more in storage until we get there, or they could create some sort of handshake agreement that they get next month's price today. And those are some things that can happen. And they won't do it in actual price, but they'll work out what is that number when you factor in insurance and shipping and provide discounts to get to that equivalent to try to keep some of this product moving, because there's still a lot of floating storage in the market. When you look at the U.S. exports on a 4-week rolling average are still elevated. When we look at what flows were today, they were about 3.4 million, still at the very high end, especially when you factor in the 4-week rolling average. Still, again, very much moving product out of the market. Out of the U.S. market and into the European markets at this point in time. When you look at the discounts between Dubai and Brent, it's at about $5.85, still maintaining, still at the high end. When you put that on a seasonal chart, it's still well above normal, and that's going to remain the case given the amount of floating storage that's in the Middle East, and just there really is no main buyer. And that's going to, the hope is for Saudi Arabia is that that's going to change. But by not being more competitive into Europe and especially the US, you're still relying on Asia, and they have an economic problem. They have a slowing economy. As we showed in the Econ Show, segments 1 and 5, their industrial production is dropping. There's a lot of problems that continue to roll out in that region. So it's tough to rely so much on that. So we don't see right now, if I had to put a prediction on it, we don't see a huge amount of buying going in January, and that's going to result in additional additional OSP cuts, and we should see some additional coming into the US, who would be a bigger buyer. Global crude on the water, you can see we're at a 2022 record. A lot of this is just a lot of Russian crude getting dumped into the water. A lot of this is trying to clear out for not only what's happening into November, but also into December. Not only into December, but also January. And it's just there's a lot of problems, which is going to keep this crude on the water in terms of miles per ton, as well as the CPC issues at the Turkish Straits that we highlighted, which is why it's no surprise to see oil in transit surge to a 2022 high. And if you look at it, it's actually approaching the 2020 highs. And just given the issues in the market, you could see one more push up where we actually set a new all-time record for the amount of crude on the water, which is obviously going to make its way into floating storage, which is why we remain concerned. You've seen differentials come off. Differentials are getting slashed again throughout the West Africa. Angola still has cargoes to sell. Nigeria still has cargoes to sell, and they're struggling to clear their underlying docket. Crude oil and floating storage coming down a bit. You can still see it's right in line with where it is in 2021. And as we've been saying, the comps get easier into year end when you look at it, which is why we figured that we were going to be pretty close to where we were in 2020, 2021. But given the sheer amount of crude in floating storage, in transit, that's going to then convert to a lot more floating storage, and that's going to put us near the highs as we exit the year. Asia floating storage coming down. A lot of that is just because of the delays getting into their market. We do see this recovering to just 2021 levels. Not a huge surge, but given the amount of crude that is targeting that region and the amount of buying that is there, and especially as the discounts get steeper, we should see them getting a bit more active, especially as runs have increased, which is no surprise to see China supertanker crude imports remaining at the highs. We've seen an increase in some of those imports, and that's likely to increase, especially when you have a bit of a spike in activity in 2022 in Shandong. You can see we went from 65.8 to 67. That's something where typically we should get to about 69, 70 at this point. So there is a bit more upside. It's just going to come down to where is the export quotas, where is storage, and if they can get some guarantees on the export side going into next year, we'll see them get closer to 69, 70% utilization rates, and some of those imports tick higher. West Africa is still sitting with a lot of crude and floating storage, which is why we're seeing additional discounts. Nigeria imports into the U.S. increased. We should start to see some of these discounts get a bit broader and steeper, because as we said, the first week of December is a little sluggish, and then because people try to see, all right, where's the market, where's the price set, and then if nothing moves, then you start to see a fairly sizable cut, and here we've started to see those discounts. Crude oil exports, when you look at gasoline, still at the highs. They declined 126,000 barrels, but still well above the 5 year. Same with distillate, dropped 26,000, but still elevated. Propane came down 42,000 barrels, but again, 519 above the 5 year. And then total crude exports bouncing around. Remember, we said 4.9 was wrong. 3.4 is probably wrong. Somewhere at that 4 to 4.1 million, which is close to the maximum that can be hit. So again, still a lot of crude exiting the U.S. and heading into the market. Gasoline, as we were saying, is going to hug the highs, either new all-time high or just stay at the very upper band of that underlying cloud. When you look at distillate well above the 5 year average, but as we were saying, just going to sit at the high end, really in the middle of the cloud, but at the very high end of the 5 year average. Typically we think it's going to continue to set these levels above the 5 year, just given where prices are, the amount of storage that has come into the PADD 3. They'll be able to put more on the open water. Crude exports just normalizing a bit, nothing too crazy here, as propylene continues to be very robust. Now, as we said last week with Fujairah, we expected some sizable builds. We got them in across the board, especially in light distillates. Total product reported was at 22.853 million, an increase of a total 337,000. Stock movements were in light and middle, with a draw in heavy. Light distillates rose 803,000 barrels. East of Suez complex weakened as market participants continue to expect Chinese exports to bolster overall supplies. Again, very much in line with what we've been talking about. Chinese refiners were expected to keep run rates high in order to support high gasoline export volumes, as the government was heard encouraging exporters to use up remaining quotas. Again, we see that as well. We don't see that changing. If anything, we could see additional quotas issued for 2023 that will be a little bit higher. Middle distillate rose 187,000 barrels. East of Suez gas oil complex was a bit weaker, as eroding arbitrage economics to divert barrels from Asia and the Middle East to the west of Suez continued to weigh on sentiment, which is a long way of saying that it doesn't make sense to send product from Asia and the Middle East into the Atlantic Basin. And given the amount of storage or distillate in PADD 3 storage, makes sense because it's going to be more competitive for the Houston to ship product into Europe, just given the proximity versus coming from Asia and in parts of the Middle East. On the buying front, market participants were not surprised that regional demand has been lackluster given the typical lull period. Obviously, given where things are, preferring not to keep high stocks during the end of the year. But then at the same time, you have industrial slowdowns, you have shipping slowdowns, so that is going to weigh on demand as well. Heavy resid fell 653,000 barrels. The bunkering hub Fujairah spot activity was seen to pick up on the back of softening crude prices, but realistically not too much movement. We do see some additional builds in both light and heavy as middle distillate holds about here. When we look at the Brent time spread, we are now in contango. You can see that it's at negative 30 cents. So clearly there is that weakening, which is why we do expect differentials to get softer, more pressure to come into the market, just because of obviously where prices have moved to. When we look at underlying flows, you can see that Libya has been holding in at about anywhere between 1 to 1.1 million. We'll get additional increases in December. Nigeria has moved from that 1.15, 1.26 in December up to 1.3 in January. We will get some delays and some deferrals, same in Angola, as we continue to see some of these elevated levels, with Norway seeing a sizable pickup. But the one that's going to be the one to watch is going to be Russia, as CPC continues to come into the market. And then given the slowdown in European demand, not European demand, but in terms of, European demand from a refining perspective, and the amount of crude floating around, you can see that we're back to the highs of 2022 for the amount of crude in storage, when we don't really see that changing in the near term. When you look at products, there were draws across naphtha, gas oil, and fuel oil, with a big increase in gasoline. So when you look at gas oil, it's still at the low end, which is why there's still going to make sense to bring product from PADD 3 into Europe. They're still running at the low end, which is why getting some additional Libyan CPC crude would enable some additional gas oil production. But it just goes to show the cost of shipping, because even at these storage levels, it still doesn't make sense to bring product from Middle East and Asia, because rates are so high, which is going to play well for being able to export from the U.S. markets. Gasoline, nice little surge, well above 2020, back to new all-time seasonally adjusted highs. And we really don't see that changing, because rates are so elevated for shipping. The ARB is kind of, depending on the day, is either slightly open or closed, and that's going to keep a lot of that product in Europe. Fuel oil, fairly stable. We don't see it diverting too much from the average. Now, when we turn to Singapore, Singapore had a sizable build of 2.2 million. That was driven by light distillate, with middle and resid staying fairly stable. So when you look at the average, the totals, it's hanging towards the average. But when you look at light distillate, we're back to new seasonally adjusted highs. We see light distillate getting worse, as we've been saying. You had the festivals, you had this pickup, and now you have all of that on the other side. Demand slowing, more supplies from China. So again, that's going to leave more in Singapore. Middle distillate, small increases, but again, hugging the bottom. But the problem is that without that exports going into Europe in the Atlantic Basin, you're going to have to find ways to support this crack spread because gasoline's getting worse, which is why we saw some sizable cuts to the OSPs on the heavy and medium front, which will be important to watch to see how that adjusts the market. Then when we turn to resid, as we've been saying, we expect this to just hang towards the average. And now when we turn to the North Sea, you can see that we're sitting right around the average, and we don't see that deviating too much. As well as when we look to Europe at the higher end, that given where we see things right now, it's going to keep European onshore storage fairly stable. And it's just going to be timing delay of when is it on floating, when is it on shore, and those are going to be some important pieces. So that's what we have for you today. If you have any questions, you can find us in the comment section. You can find me on Twitter, by email, and we hope you enjoy the rest of your day. Thanks for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.